Okay, let's talk about the Federal Reserve in 2026. Because right now, they're walking on the thinnest of tightropes. You see, after this long, drawn-out fight against inflation, the global economy is starting to look, well, a little shaky. And the next decision that comes out of Washington, it's not just going to hit Wall Street. Oh no, this is going to send ripples across the entire globe. The stakes, they honestly could not be higher.
And it all really boils down to this one massive question. Are we about to see a much-needed course correction to save a sputtering economy? Or are we about to witness a catastrophic policy mistake that unleashes the very inflation they fought so hard to put back in its cage?
You see, the Fed is stuck in a classic bind. They're basically fighting a war on two fronts. On one side, you have an economy that's clearly cooling off and, frankly, begging for some relief. But on the other, you have the stubborn embers of inflation just waiting for a chance to roar back to life. There's just no easy answer here. And this slide right here lays it out perfectly. It's a classic catch-22. If they cut interest rates to try and jumpstart growth, they risk making a huge policy error that lets inflation run wild again. But if they keep policies super tight to stamp out that inflation for good, they could very easily push the whole economy right off a cliff into a full-blown recession. All right, so let's dig into that first front in the battle. The really powerful arguments for actually cutting interest rates. I mean, why is there so much pressure on the Fed to do something, like right now?
Well, the biggest driver, the thing everyone is pointing to, is that the economy is clearly slowing down. The data is pretty unmistakable. You can see the engine of the economy is just losing steam quarter after quarter. And a lot of people are worried that without some kind of intervention, it could just stall out completely.
And this slowdown isn't happening in a vacuum. It's being made so much worse by all these other pressures. You've got volatile financial markets that have investors on edge. Businesses are struggling under these massive debt loads, which makes it really hard for them to invest and grow. Even the government is feeling the squeeze from the soaring cost of its own debt. And then you layer on top of all of that this intense political pressure to just do something to provide relief.
But now let's switch gears and look at the other side of this battlefield. Let's talk about why the Fed is so hesitant to act. This is all about the lingering ghost of inflation and the deep, deep fear of repeating mistakes of the past. And here is the absolute crux of the issue. Even with all the progress they've made, inflation isn't gone. It's not defeated. It's still just hovering there, stubbornly above the Fed's target. It's this constant reminder that it is way too early to be declaring victory. This timeline really illustrates the historical lesson that is just burned into the memory of every single central banker. In past fights with inflation, they eased up on policy too soon. And what happened? Inflation came back with a vengeance, a second, more powerful wave, and that forced them to take even more painful, harsher actions to get it back under control. It's a mistake that absolutely no one wants to make again.
Which, of course, forces us all to ask that really uncomfortable question. Is the Fed standing on the edge of making that exact same mistake all over again?
So, with all these opposing forces pushing and pulling, the Fed's next decision could send markets down two completely different roads. Let's take a quick look at what those potential futures could look like.
Okay, so scenario number one is the rosy one, right? It's what everyone calls the soft landing. In this future, the Fed just nails the timing. They cut rates perfectly, easing up just enough to support growth without letting inflation get out of control. If that happens, investors would breathe a massive sigh of relief, and you'd likely see a huge rally in stocks and other assets.
But then there's the other scenario, the much darker one, the policy mistake. In this version of the future, those rate cuts are seen as a total disaster. Inflation fears would just explode, and markets would panic, thinking the Fed has completely lost its grip.
So let's break this down. What does this actually mean for your money? In that soft landing scenario, the good one, stocks would probably surge on all that renewed optimism. Bond yields, which move opposite to bond prices, they'd fall as the market prices in a healthier economy. The dollar? It might weaken a little. But in the policy mistake scenario, whoa, it's the complete opposite. Stocks would fall as fear takes over, bond yields would spike to account for higher inflation risk, and the dollar could swing wildly as investors desperately search for safety.
Now, it is absolutely critical to understand that this isn't just about the U.S. economy. The Federal Reserve, for all intents and purposes, is the world's central bank, and its decisions create these powerful ripple effects that wash over the entire global financial system.
And to really get this, we need to talk about something called global capital flows.
This is basically the world's money in motion, billions and billions of dollars flowing between countries, always looking for the best safety and the best returns. And the Fed's interest rate decisions? They act like a giant magnet, pulling those flows in one direction or another.
So how does this actually play out across the globe? Well, a shift in Fed policy can instantly put huge pressure on emerging markets that have borrowed in US dollars, because suddenly their debts are more expensive. It can cause capital to literally flood out of other countries overnight. And that, in turn, can cause currencies to swing wildly and totally change the financial conditions for businesses and governments all over the world.
This quote really just says it all, doesn't it? The decisions made in Washington don't stay in Washington. They fundamentally shape the entire architecture of global finance. And when that policy shifts, well, markets everywhere have no choice but to adjust, and that adjustment can often be pretty messy.
And that brings us right back to the core of the problem. You've got the risk of a recession on one side and the risk of inflation coming back with a vengeance on the other. You have to understand, the Federal Reserve isn't choosing between a good option and a bad option here. It's trying to figure out which path is the lesser of two evils.